We're going to move on to a bit of analysis on DeepSeek, a bit of tech commentary analysis from a couple of research reports. There are very good things happening in other sectors of the markets, in particular the US banks. So I'm going to be talking a bit about that as well. So the past week we've had these sweeping tariffs on Canada and Mexico. They've been postponed for a month. Also, some tariffs on China, particularly damaging if they do eventually get implemented for Canada and Mexico. In fact, it's highly likely that those two economies will tip into recession if the tariffs are followed through. And also, it's not particularly good for US inflation either. And if they are implemented as threatened, US inflation will probably run back to 3%, which will all but kibosh any prospect of further Federal Reserve interest rate cuts. And when that DeepSeek announcement came out, and it actually caused the NASDAQ index, which is very heavy in tech stocks, to experience its sharpest single-day drop since the onset of the pandemic. So it was pretty hectic. I think it was about 4, even 5%. The good news is that most of the shares that were heavily impacted, the semiconductor companies like Nvidia, are considerably underweight in all the investment companies that focus on that area of the market that are represented in our global portfolios. So I think the managers of those investment companies have been well ahead of the curve. But it is far from clear, despite the drop in the NASDAQ index, that the development of new and cheaper large language models, LL, is necessarily bad news for all technology firms. And we will discuss that in more detail later on. It helps to bring costs down, which is crucial to encouraging the adoption of new technologies. So we'll be getting a pivot from the developers of AI infrastructure into the companies creating applications for AI. So instead of semiconductors, we can expect much more exciting re-ratings and potential earnings growth from the software developers. And this, of course, is ultimately what is required to increase productivity. A few more macro highlights. The US economy, they had their Q4 GDP report last week, very robust. Real personal consumption increased at an annualized rate of 4.2%. And the FOMC, the Federal Reserve Open Market Committee, kept the Fed rate unchanged, as expected, but it still has a dovish bias. They have eased the policy rate so far by 100 basis points, and they are likely to continue erring on the side of an easing bias. According to the futures market, there is no rate cut expected in March, but there will be another 25 bips in the middle of the year. Some interesting analysis here from MRB, and I quote, "Will the tariffs be large enough to trigger higher inflation and ultimately weaker global growth? I don't think so. But if so, the Fed will ignore a period of higher consumer inflation if they fear that economic activity will weaken meaningfully, i.e., they will once more expect only a transitory inflation spike." If we look at other central banks, the ECB did cut by 25 basis points last week, and they expect to cut again by another 25 basis points in March. And of course, the Eurozone and Eurozone economy is not enjoying the robust growth that has been enjoyed in the US. So there's more urgency for monetary easing in that region, as is in other regions. Canada, for instance, the Bank of Canada also last week, as expected, cut its policy rate by 25 basis points. So what is the outlook for financial markets? We have some research from MRB to begin with, and they have tended to be the most bearish in terms of the relative outperformance of US markets. But they say that they expect US markets to be well supported by rising earnings on a 6 to 12-month horizon. Investors in US equities have generally embraced the pro-growth elements of the new Trump administration's policy agenda. There is scope for animal spirits to ramp up further in the near term. Solid US economic growth and AI-led productivity gains, robust corporate earnings bolstered by deregulation, dormant inflation, and a non-threatening Federal Reserve, all positive for US risk assets. So now we're going to turn to the view from Alpine Macro, and it's a little bit technical, this, because it relates to the bond market and the bond yield curve. So the yield curve is the difference in the interest rate between short-dated bonds and long-dated bonds. And at the moment, the yield curve is positive, which means that long-dated bonds are higher than short-dated bonds. But not only that, the yield curve is steepening, which means that the difference between those short and long-dated yields is growing. So you get two types of bond yield steepening. You get what's called a bull steepening, and that's when short-term yields are falling faster than long-term yields. And you also get a bear steepening, which is when long-term yields are rising faster than short-term yields. And that is what we've got at the moment. And this is what Alpine Macro has to say about it. Usually a bear steepening is the sweet spot for equity prices, as it means monetary policy is either non-restrictive or easing, while underlying growth is strengthening. Currently, the bond market is going through such a bear steepening, a key reason that stocks are booming. Trump's speech at the Davos World Economic Forum made clear that he wants cheap oil to drive the US economic expansion while hurting Russia in order to end the war. And then last section on macro from Capital Economics, and this relates to some degree to the DeepSeek story. We don't think US equity market outperformance is over yet, despite the challenge from DeepSeek. DeepSeek doesn't seem like an existential threat to the overall AI bubble to us. If anything, the interest in it emphasizes the hype around the technology. AI technology is still evolving very quickly, and we think the US big tech sectors are well placed to remain at the forefront of it. So let's have a deeper dive into DeepSeek. So we've got a little bit here from Alpine Macro. The advent of DeepSeek, a generative AI platform from China, signals a new era for hyperscalers. But businesses which benefit from the democratization of generative AI should thrive. And they've got an amazing chart, and it shows the revenues from AI expected over the next 5 or 6 years. AI revenues are expected to explode, but the composition of those revenues is changing. So infrastructure spending has really led the way until now, and the leadership will change towards AI applications. But of course, all of that is good for technology and the tech sector as a whole. And it's worth mentioning that Allianz Technology, which is the largest holding in our portfolios, and we've recently just increased the weighting, has a lot of exposure to those AI application companies, a lot of exposure to the smaller mid-cap technology shares that are expected to lead the way in the next chapter of the AI boom. So just now, let's move on to capital economics. Also, their confidence and enthusiasm for AI remains and they refer to Donald Trump's Stargate project. Stargate, announced within the first week of his presidency, is another shot in the arm for AI, and it supports capital economics' long-standing view that the S&P 500 will thrive in 2025, in fact, outperform other global markets, amid growing investments in and enthusiasm for this transformative technology. Stargate is a new private company which plans to invest $500 billion over the next 4 years building new AI infrastructure. Also worth mentioning, the new president, Donald Trump, seems much less keen than his predecessor on imposing checks and balances, i.e. regulations, on the spread of AI. He has already revoked Order No, which refers to safe, secure, and trustworthy development and use of artificial intelligence. So this deregulatory attitude towards AI, according to capital economics, reinforces our view, and we are sticking to our forecast, that the S&P 500 index will end 2025 at 7,000 index points. So it's currently just over 6,000, implying a return for that index of around 15%. But of course, even though technology comprises over 30% of the S&P 500 index, it's not all about technology. The US economy is led by consumers. Consumer expenditure comprises around 70% of US GDP, and another sector, a very significant sector in the US economy, is the bank sector. And banks are expected to perform exceptionally well under a Trump administration, deregulation, and steepening yield curves. Banks are also incredibly well capitalized, the best, highest capitalization ratios in decades. The S&P 500 Banks Index have enjoyed a strong 2024 and have been one of the major winners since President Trump's election victory. And capital economics have identified 3 main factors driving banks, which I expect will continue in 2025. First of all, banks' net interest margin has increased as the yield curve has increased. We expect long-dated Treasury yields to remain high, and we forecast the Fed to cut interest rates by another 50 basis points this year, causing the curve to steepen further. The second factor relates to optimism around the US economy. US high-yield credit spreads have dropped to fresh post-global financial crisis lows in the past week. Loan demand and credit quality tend to be more favorable when GDP growth is robust. Bank stocks tend to be among the most cyclically sensitive. And the third factor is the anticipation of banking sector deregulation. Valuations of bank stocks generally look low, both in absolute terms and by past standards. On balance, we think that bank stocks will remain around the front of the pack over 2020. So, as well as increasing the weighting to AI-themed stocks through Allianz Technology, we have also increased the model weightings to Polar Capital Global Financials, which has a very large emphasis on US bank stocks. All right, that's it from me, and then handing over to Sean on the local side.
On the macro information front, we'll start with PPI. After having 2 positive months of PPI declines in October and November last year, we saw an increase in PPI of 0.7% year-on-year for December 2024. The increase in prices was mostly driven by a rise in prices of food, beverage, and tobacco products. The 2024 figure still improved though from 2023, slowing from 6.9% to 3%. Looking at the CPI figure, it came in at 3% year-on-year for December, sitting on the low end of the target inflation range of 3% to 6%. With inflation under control, it was likely that the Reserve Bank would cut rates on Thursday last week. Bloomberg and other market participants' consensus was a 25 bp rate cut, so the cut that was announced was very much in line with expectations. This now brings the prime lending rate to 11%. Although inflation has been below the midpoint of the target range for some time now, there is a chance that rates are not cut by as much as analysts originally thought going forward. Lesetja Kganyago could end up taking a more hawkish stance given some of the MAGA policies that Trump and his administration have tabled as potential routes that they may take. Tariffs, which we have already seen plenty of action on this week, tax cuts and deregulation are all inflationary. If the US economy heats up too quickly, they could very well keep rates higher for longer. If US rates remain high, it makes it difficult for countries like South Africa to continue cutting, as it will have a negative impact on our exchange rate as investor funds leave our shores in search of higher returns. There is still a possibility, however, that a further 25 basis point rate cut does take place later this year. But given the fact that 2 Reserve Bank members voted against the cut this time round, rate cuts are likely going to be paused for the time being. Our exchange rate versus the USD has fared quite well compared to other emerging markets in recent months, so Kganyago will be cautious with any decisions as we move into the future. Moving on to the PMI figure for Jan 2025. The ABSA PMI figure fell 0.9 points to 45.3 in Jan this year. After 3 months of contraction, which is indicated with a score of less than 50 points, there is concern around the manufacturing sector's sluggish recovery. Positive factors include improving business activity as well as new sales, but these are unfortunately being outweighed by the negatives at this point. The employment index dropped, manufacturers are hesitant to hire more workers, and supply deliveries have weakened. Last month, President Ramaphosa signed the Expropriation Act, with the main focus of addressing the imbalance of land ownership in South Africa. By this point, most are aware of the tweet sent out by President Trump on Sunday, where he threatened to cut funding to South Africa until a full investigation takes place on, quote, South Africa confiscating land. Regardless of where you stand personally on this issue, as investment managers, we do need to ask ourselves, what effect could a cut in funding have on South Africa as a country and an economy? There would be 2 main effects, one on trade and the other on aid. The US has been a long-standing partner and ally to SA. In 2023 alone, the US supplied South Africa with about $440 million, million of which went to life-saving HIV and AIDS treatments, as well as support services, with other funds going towards health issues, farming, trade policy, and energy. Additionally, a quarter of SA's 15 billion USD exports to the US get preferential tariffs under the AGOA Act. Although other tariff threats made by Trump this week may have been dubbed as negotiation tactics, we will not want to ruffle his feathers. The situation needs to be dealt with professionally and in an orderly manner by President Ramaphosa. Eskom tariff increases. Last week, a tariff increase of 12.7% was approved by NERSA for the 2025-26 year, with another 5% and 6% allowable increases for the following 2 years to come. While still hefty, the lower than applied for tariff increase will be positive for inflation and consumers, but will be negative for Eskom, given the fact that they were hoping for higher tariff increases. While some might believe this is the reason Eskom decided to turn off the lights last week, don't be fooled. Yes, that's right. After 300 days of generator-free afternoons, load shedding returned, even if just for a moment. Standard Bank reported that boiler tube problems at the Matimba and Letabo stations, as well as breakdowns at the Kendall and Creel stations, were the main cause for your romantic candlelit dinners over the weekend. Although the electricity giant is still said to be plagued by mismanagement and a lack of internal controls, they have made considerable improvements since the forming of the GNU.